Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I must apologise, as you can probably tell, and you probably will tell even further into today's episode, I'm suffering or just recovering from a bit of laryngitis, which is, hanging around like a bad smell, really, and has delayed, the recording of the podcast a few days. Anyway, we'll see if we can get through it. But if my, voice starts to weaken a little bit, I apologise. Got to hang in there. The show must go on. Okay, so in today's episode, I wanted to talk about the last 5 years of property data. And I guess there's no such thing as a normal market. There's no such thing as a normal market in the property market, in the share market. There's always something unique going on. There's always a unique risk or a unique opportunity. So nothing is ever like perfect. And, there's never perfect investment conditions either, by the way. So there's always a reason not to invest or to delay investing. So if you're waiting for, the perfect weather to make a financial decision, it's probably never going to happen. But the last 5 years, there's been some really unique, hopefully one-off factors. It's not just COVID, although many have been impacted or driven by COVID, that it is going to skew property data. And the problem with this, and particularly for buyers agents that are borderless and very data-driven, and so there's a few firms out there that are exactly as I describe, that will justify a lot of their investment thesis around data. And sometimes that data also includes most recent growth and so forth. And of course, it might feel really safe or attractive to invest in an area that is currently on an upswing, because you hope that it will continue and that you can capture those early returns and so forth. But as I said, I think we've got to be really careful about, relying on the last 5 years of data. And I'm going to explain why and share there's a bunch of factors that have kind of impacted or skewed data over the last 5 years. And actually, I'm going to suggest that perhaps, the conclusion really is perhaps we should be ignoring the last 5 years. And so there's 5 things that I want to talk about today. So let's get into it. The first one is really around building costs, so cost to construct. And according to ABS data, the home construction costs have risen by about 40% really since the start of COVID. But I think it depends on the location, of course, and the type of dwelling that you're building. But some of those have risen by more than 40%. Like I know a lot of developers are talking about apartments, for example, and particularly higher density apartments, mid to high rise. The cost to construct those sorts of dwellings has increased. But of course, construction costs impact other sort of facets of the market as well in terms of renovations. So even existing properties that might need to be renovated. Of course, the cost to do that renovation is much higher today than it was 5 years ago. And of course, there's a couple of observations that we can draw from that. Firstly, it pushes up the replacement cost of an existing property. Normally land appreciates and buildings depreciate over time. But over the past 5 years, both land and values arguably have appreciated, which is an unusual situation. The second observation is that fully renovated homes have enjoyed much higher demand. In fact, let me put it the reverse way, that unrenovated homes have been more unpopular than they usually have been because most buyers have been concerned about construction costs and they don't want to buy something that they need to renovate because they're worried that the construction costs will blow out and actually it'll end up costing them more than if they bought something that's already done. So they therefore prefer sort of turnkey homes or dwellings, particularly if they're owner occupiers. And so very much the renovator's delight has been unloved over the last 5 years. And so if you look at the relative performance between those two types of properties, you're probably going to see, as a general rule, a big disparity. Now, of course, that's not going to be true in every single location in Australia, but just as a general theme. Now, of course, this trend's going to have a bigger impact on growth rates and property prices in areas where land values are lower. And in those markets, it tends to be that the improvements on the property make up a greater share of the total property's value. Now, of course, the property's value is made up of the underlying land value plus the improvements. And so if we're in a lower land value location and building cost to build, jumps 40% as it has, and the improvements are worth 70% of the property, of course, that's going to have a bigger impact in that location. Whereas in very high value land value locations, and those tend to be blue chip suburbs, for instance, normally the land is the greatest share of the the total asset value. So land value might be 60, 70, 80% of the total value. So the improvements value it will have a smaller impact. And I think we've probably seen this in the numbers, right? You can see some sort of secondary and even outerline suburbs have experienced some strong growth. Well, the thing is that might not be because the underlying land value is increased. That could be the one-off spurt in construction costs. Now, construction costs have leveled out. ABS producer price data shows that it leveled out by about they've only grown at 1.35% over the last 2 years. Now, pre-COVID, construction costs, if you go back to the 70s, on average, construction costs would grow at 5% per annum. So that's kind of the normal, if you like. We're now below normal, mean reversion. That's not a surprising trend that we get lower growth after a period of much, much higher growth. But really, we're dealing with the new normal. So I don't think, I think the chances of construction costs coming down, they could, but I think they'll probably just stabilise and go sideways for a number of years. But I think this is a permanent change in the cost to construct a dwelling in Australia. And that's going to have a permanent impact on prices, or a one-off impact on prices over the last 5 years. So the key takeaway here is when looking at property price growth, when comparing different locations to invest in, and when looking at past performance, we have to start thinking about how much is construction costs contributed to that performance in that location. And that's going to depend on, the type of property you're buying in terms of house, apartment, unit. It's going to depend on the average age of the property in that location. It's going to depend on the underlying land value and what proportion of the overall value that land makes up. So it's going to be different for different locations, but it's something that we should adjust for, or at least we should think about adjusting for or consider. Now, it's not going to be necessary in every location. If you're buying in a land value heavy location, we might not need to adjust for it. However, in that situation, so if I'm thinking about, for example, a Victorian cottage that was built, 110, 120 years ago, and it sits in a blue chip location on a very, albeit small, but very valuable parcel of land. In that situation, those properties aren't brand new. They're not all shiny and new. So actually, they're probably being punished a little bit over the last 5 years because of this construction cost situation. So there's going to be situations where you need to adjust down the growth rate, but there's going to be other situations where you might go, well, the last 5 years have been undercooked because of this instance. So that's the first one, is construction costs. The next major change over the last 5 years, and I'll probably broaden it out to say the last 8 years, although there's been a lot of changes over the last 5 years too, is borrowing capacity. So back in 2017, that's when APRA started to tighten the credit rules, and the major changes dating back that began really in 2017 was living expenses. So instead of using an index for living expenses, which is always really low, like for a family, they might have assumed $40,000 for living expenses, whereas today the real number's probably 80 to 100,000. So that's where that was really inflating borrowing capacities, or overstating borrowing capacities really from that perspective. So that was one thing they tightened up. And then the other thing they tightened up is interest-only lending. So that's when APRA introduced caps on the amount of interest-only lending they could do, and that's when they introduced higher interest rates for interest-only loans, particularly for home loans, but even for investment loans. They've come off a little bit now, like the gap has contracted a little bit, but there's still that interest rate premium that you need to pay. And then, of course, there was the interest rate buffer. So they lifted it in 2019. The buffer was 2%. They lifted it to 2.5% in 2019, which is just before COVID. So, the market was just starting to adjust to that sort of borrowing capacity change, if you like. Now, we can't forget, it feels like a lifetime ago, but we can't forget, before COVID, the cash rate was 1.5%. As I'm recording this just before Melbourne Cup Day, so before the RBA meets, although it's not expected to cut interest rates, the cash rate is 3.6%. So whilst APRA was adjusting these credit criteria, they were doing so in a very low interest rate environment, which insulated the impact quite a bit in terms of the impact on not only borrowers, then obviously the flow-on effect of in terms of cash that goes into the market. Now, it starts to feel like a bit of a history lesson here, but then obviously COVID hit, and the RBA slashed interest rates almost to 0.1%, but it dramatically reduced borrowing capacity costs, I should say, and somewhat offset the impact of APRA's previous rule tightening, the rule tightening that occurred over the previous previous 3 years. However, in 21, APRA intervened again and increased the interest rate buffer. And the interest rate buffer, remember, is the amount of interest rate they build on top of the current interest rate that you're going to pay to ensure that you can afford to keep up repayments if interest rates rise. So they increased the buffer from 2.5% to 3%. Now at 21, that was probably an okay thing to do given interest rates or the cash rate was virtually zero, but maybe less appropriate when the cash rate is at normal settings. Anyway, since 21, obviously we know what's happened. The cash rate blew out to 4.35%, and of course it's 3.6% today. But at these interest rate settings, and really the settings over the last sort of 1 or 2 years, the impact of the previous tightening that had occurred since 2017 has been fully felt. And that's had an impact on the market. And of course, these borrowing capacity swings sort of changed people's capacity kind of overnight, if you like, or over a very short period of time. And as borrowing power has compressed over the last 2 to 3 years, it's pushed buyers into more affordable markets, which could be smaller capital cities, regional markets and so forth. And then of course the pandemic and lockdowns and the rise of work from home only amplified the impact of the higher demand in those locations relative to the more expensive capital cities. So as you can see, the impact of borrowing capacity or credit changes and then the impact of changes to interest rates subsequent to those credit changes has really had an impact of skewing, borrowing capacities and then purchasing patterns in Australia. And I just don't think that the regulators really have any appetite to relax credit standards in Australia. So, they've talked about, or they're being pressed on, should they change that 3% interest rate buffer? Look, I think they should. I think they should have a buffer but a cap. So maybe it should be 3% but a cap at 8% or something like that, or even 8.5%. So I think they should make that change. That seems common sense to me, but anyway, I don't think they've got any appetite to do that. And the RBA has previously indicated that it thinks its neutral cash rate, so that's a setting that's neither expansionary or contractionary, sits at somewhere between 3 and 3.5%. It's a bit hard to sort of work out. It does change over time due to different settings like household indebtedness and so forth. So you can't really compare to, say, 20 years ago because households are far more indebted today than they were 20 years ago. So it's a bit hard to know exactly what that setting is, but we're pretty close to it today. That means borrowing capacity settings and the cost of repayments and interest rates and so forth really is kind of normal. We should regard it as normal today, and it's probably not going to change. Now, historically, of course, most investment dollars have flowed into major capital cities, Melbourne and Sydney, Brisbane. Really, that's where most of the dollars have gone in terms of property investors. And of course, for obvious reasons, that's where the strongest demand is. That's where the greatest share of the population lives. And of course, supply is constrained as well. You think about Sydney, you've got some geographical restrictions in terms of its ability to grow. In Melbourne, you don't have those geographical restrictions, but you've got problems with infrastructure, and that's just going to be a growing problem that you see more on social media these days of people living in these new build areas that take 2 hours to get to and from work. That's just not going to work for a lot of people. So that's where most investment dollars have flown, but really over the last 5 years there's been a lot more investment dollars go into regional areas and smaller capital city markets. And it's worth asking as investors whether we think this is a structural shift or whether it's a temporary one. And I would lean towards a temporary one. The thing we've got to remind ourselves, and something I've been taught many times over the last more than a couple of decades, is that quite often fundamentals don't change. The reason why everyone is living, or most of Australians live in Sydney, is because there's fundamental reasons for that, fundamental factors that haven't changed just because interest rate change or borrowing capacities have changed. So again, we need to then think about how is this skewed data, and we need to take that into account when making investment decisions. Now, I guess if I, think of devil's advocate and think about the counter argument to that, you might go, well, yeah, Stuart, but, people just can't afford to invest in Sydney anymore. So that they're going to have to look at regional areas more and more as the prices get higher and higher. But really, you could have made that argument any time over the last 40 years, to be honest. There's never been a time where properties seem cheap. Well, maybe Melbourne, you might go, relative value is is cheap, but that's a really unique situation most of the time. But even in Melbourne, really, when you go and look at a property and it sells for $4 million, you think, gee, that's expensive. So properties never seem cheap, and it's always seemed expensive. Sydney's always been expensive, from a consumer perspective. But the reality is that, the demand's still dry, the demand is still there, the supply is constrained, will always be constrained, and I think that's where most investment dollars will tend to gravitate towards. So when looking at the last 5 years of data, or even you expand that to the last 8 years of data, we need to start thinking about how borrowing capacities, and there's probably once-off change in borrowing capacity, a permanent change in borrowing capacity, has skewed data, and whether it has impacted data, and to what extent, and whether you think that's going to be a one-off change or not. Okay, the next item or factor that's changed I want to talk about was overseas migration. And look, there's been a lot of discussion about the impact of overseas migration on the housing market, and it continues to be, by the way. During the pandemic, of course, border closures meant that there was no immigration, but really since reopening, and I've got a chart where I've looked at the net overseas migration, and really before COVID, so between 2010 and 2019, it averaged about 218,000 people per annum that came into Australia, overseas migrants. And the data is really noisy, after COVID, of course, because it obviously goes negative for a period of time and then really strongly positive. But the average since 2020 is 261,000 people. So that's a pretty significant increase. It's 20% really above that pre-pandemic level. So it's going to have a pretty big impact. Now, it's important to understand what is included in this net overseas migration numbers. Now, typically it's made up of temporary visa holders, most of them being students, permanent migrants, and New Zealanders. But around 70% tends to be temporary visa holders. So they're the lion's share of it. Now, temporary visa holders, difficult for them to get loans. They can only buy brand new properties. They need Foreign Investment Review Board approvals, so government approval. So it's really difficult for temporary visa holders to buy property in Australia, typically. And so most of them are renters. And so obviously that's going to this increase in net migration has a real impact, or probably has the biggest impact in the rental market than other markets. So it's not surprising then that we've got a rental vacancy rate in many jurisdictions below 1%. And for context, the normal vacancy rate is around about 3%. That's considered like a balanced market. So 1% certainly is not a balanced market. And over the year to September 25, Coality reckon that rents have increased by about 4.3%. So, there was a strong rise or increase in rents a few years ago. They were double digit almost. So that's sort of come down a little bit, but still growing faster than inflation. And I'm pretty sure rents are part of CPI, so that's obviously giving rise to higher inflation, or contributing to the higher inflation readings as well. Now, beyond the rental market, of course, increasing immigration tends to drive economic growth, although it hasn't really driven labour productivity, and there's been a bit of analysis about that. But what's really surprising is that about 80% of net overseas migration goes into Sydney, Melbourne and Brisbane. And given this, I'm kind of surprised that those markets, Sydney and Melbourne, for instance, over the last few years, certainly not Brisbane, have underperformed. Because you would think because there's greater demand from renters, more investors would be attracted into these markets. But obviously, there's lots of moving parts to property prices and property price movements, as I've previously spoken about. I recorded an episode recently where I concluded that I think lending data really sums it up perfectly. But, if you think about borrowing capacities like I just spoke about, maybe that could be the contributing factor there. So what's the takeaway here? Well, I think when looking at rental yields and growth in rental income over the last few years, I think we've got to be careful. And there's going to be probably a one-off spike as a result of what's happened with immigration and changes to immigration. We can't extrapolate that or expect that to persist forever. Now, next one I want to talk about is work from home, and I think that's had a big impact on property demand or buyer demand over the last few years, and it's swung in sort of both directions, I think. So As we all know, we had lockdowns, pretty severe lockdowns particularly in Melbourne, of course. And overnight we were forced to work from home, or at least most industries or many industries were. And really before the pandemic, often work from home was viewed with some level of skepticism. People sort of questioned about whether the people were actually working and what productivity they were delivering and those sorts of things. I would even speak during COVID to some clients that are CEOs of large businesses, and they would say, pre-COVID we'd never work from home because, we'd want to be seen in the office, whereas that stigma has now reduced. And so I think the skepticism, some of it's still there, but it's largely disappeared. People, not always in every situation, every industry, but people know that if you're working from home, chances are you're probably working just as hard, if not harder. But of course, since the pandemic, working from home has actually remained a permanent feature. Although, some businesses, industries are starting to wind that back. They're arguing that the pendulum had swung too far and maybe we shouldn't be working home 4 or 5 days a week, but maybe, 1 or 2 days a week is fine. So, where it went sort of 5 days and then sort of 4 days, it's sort of starting to sort of slowly swing back. But I think it's going to be a permanent feature in many industries that is going to be some level of kind of work from home, but maybe not to the extent of permanent, 5 days or, only 1 day in the office, which was, what I think maybe a lot of people might have expected a few years ago, right in the middle of the pandemic. Now, Melbourne's the outlier here. I think they've been much slower to return to the office. If you're in the city on Mondays and Fridays, it's really quiet. And of course, the current Victorian Labor government's proposal to kind of enshrine work from home as a right for employees 2 days a week isn't really helping the return to office movement as well. And the city consequently is, struggling to recover. But we've got to think about what this sort of change has driven, because at some point, let's call it 22, 23, there was a strong movement from workforce to think, okay, now I have flexibility that I never had, that travel to work is no longer a consideration where I want to live. A lot of people then really thought, okay, we're going to go live down the beach or, live outside a capital city, go into a regional centre or something like that, because I thought, okay, we're never got to travel to the office anymore. But of course, that's normalised a little bit, and now that's not always going to be the case, or I would actually probably say it's going to be rarely the case, that, people are going to probably have to go in the office at least 3 times a week, and so therefore travel time now starts to become more of a concern. I did actually do a podcast around that time saying I disbelieve that this was going to be a permanent change. But I guess when we look at past data, we've got to realise that there's been kind of a one-off increase in demand in those locations for a period of time, and then we've got to consider whether that is sustainable or whether it's going to come back and normalise to sort of pre-COVID levels. Now, what tends to happen in property markets, as I've spoken about before, if they enjoy periods of above average growth, a property market typically won't correct like a share market will. It can in some markets, and particularly in sort of beachside locations where prices can become quite overcooked very quickly, they can drop 10 or 15%. But in most locations in Australia, what will happen after a growth spurt is property prices will be stagnant for a period of time until that mean reversion catches up. And I think that's probably the impact of work from home that, we're most likely to see in those locations. That is, that it's probably just going to move sideways for a period of time. So again, when looking and considering where we're going to invest and all those sorts of things, we've got to think about the impact of work from home. And the last element I want to discuss is interest rate shocks. So as I said earlier, and it's again hard to fathom really, but before COVID hit, the standard home loan interest rate was around 3 to 3.5%. So, compared to today, which is probably around 5 to 5.5%, it's a much more attractive level, but by late 2020, of course, fixed home loan interest rates had fallen to around 2%. Remember, the RBA was lending money to the banks for 3 years, fixed for 3 years for virtually nothing to try and get that cheap money out there, help people through that COVID period. And variable rates were sort of 2.5 to 3%. So, money was very, very cheap. And by 21, one, we even saw some fixed rates with a 1 in front of it, so below 2%. And we've never seen that before, probably never see that again. And of course, those ultra low interest rates encourage a lot of Australians to borrow money, and lending volumes peaked by early 2022. Now, this has a big impact. Interest rates has a big impact on the demand for lending. Interest rate is the price of the product, and when the price of a product falls, typically demand rises, of course. But by the end of 23, the party was well and truly over, and interest rates had risen 2.5 to 3 times more than they previously were. So typically around or north of sort of 6%. Now, previously I've spoken about and written about how changes in the supply of credit have a significant impact on property price growth. And so I spoke about that, in fact, last month, episode 378, if you want to go back and have a look at that episode. So clearly what we've had really low interest rates, massive spike in volume. Arguably, maybe volume was even higher than normal pre-COVID, just because of really interest rate settings. Then we've been smashed with interest rate increases, which obviously brought back volume again. And then sentiment changed in terms of interest rate reductions. We've had a few this year, which has seen a spike in volumes again. Now, the key question is, where is that volume going? Well, we know a lot of it went into Adelaide, Perth and Brisbane, and we've seen the consequences of that. But those massive changes and swings in interest rates, we need to start thinking about, what impact has it had on markets? It's going to have different impacts on different markets, and particularly more affordable markets. Whereas when interest rates are set at a more normal level, the psychology around investing means that we tend to think a little bit deeper about, our decision making, both from an owner-occupier and investment perspective. Whereas in a low interest rate environment, asset misallocation happens because money's cheap, right? So the opportunity cost is very low. And so over the last 5 years, we've had such volatility in interest rates, and that's definitely going to skew property data. To what extent, you need to think about that from yourself. So what does all this mean? Well, I think there's kind of 2 takeaways from this. The first thing is that the last 5 years worth of data is being influenced by these 5 factors I spoke about just now, and they're going to impact different property types and different locations differently. So, I think there's going to be some areas in Australia, maybe there hasn't been a lot of impact. There's going to be others that are being impacted a lot. I think when looking at past data, that's a really important question we need to ask ourselves. Now, there's no such thing as a normal market, as I said at the beginning. There's always going to be some sort of shock, interest rates, GFC, market crashes, all these sorts of things. There's always going to be something. So I'm not suggesting that, we need to be adjusting patterns and growth patterns all the time, but I think certainly the last 5 years has been really interesting. So what I would do is I would consider that, and then what I would do is sort of cast my mind back a lot longer period. So really look over the last 10 and 20 years, including and excluding the last 5 years, just to try and build a bit of a picture there, and just be careful about not being overly influenced by the last 5 years of data. The second thing is there has been an explosion of data-driven buyers agents. Again, I said that at the beginning of today's episode, and these buyers agents tend to be borderless as well, which means that they buy anywhere in Australia, and they can base their recommendations off a bunch of data. Maybe they're buying quite often they're buying all the same reports in terms of the same firm is producing that data. And I think that can be troublesome because you can end up making a very expensive mistake. Now, I've written before about the value of buyers agents, and it really lies in their deep knowledge and experience that they've built up in a particular location over many years. And there's always nuances in locations where you can't just apply a pure rules-based approach in every single location, because there are nuances that you need to take into account. Now, I've got an episode lined up for the 19th of November, 19th of this month, to go into it a little bit more detail, to give you, more detailed examples of why you need that. You need to complement the data with that local area knowledge. So certainly look out for that. But, there's going to be some investors that are going to be influenced by a sales spiel around, this is what this area has done, this is the growth rate, this is what you can expect. And I just think people need to be really careful, firstly, about following just a data-driven approach and paying someone that isn't a local area expert. And remember, I'm completely independent here. I don't have a dog in the fight. We don't offer buyer's agency services and never will to protect our independence. I'm just an independent arbiter or commentator really here, so I don't have a vested interest. And just being careful, as I said, firstly, try not to avoid using that pure data-driven approach. And if you are going to be influenced by the data, just really consider whether the past 5 years of growth has misrepresent or could misrepresent what a reasonable expectation of future growth could be. Okay, there you go. My voice has weathered the storm, lasted the episode. Anyway, I look forward to speaking to you next week. Hopefully it's recovered even further. And in fact, next week we have Campbell hosting the podcast, so that's good. That will definitely give my voice a bit of a rest. And so until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.